Wow, that was fast. Good afternoon, everyone, and welcome to the first Stern Economic Outlook Forum. My name is Kim Schoenholtz, and I'm the director of Stern Center for Global Economy and Business, which is sponsoring today's forum. We're delighted to have three very distinguished panelists, and in light of the obvious interest in this program, they need relatively little introduction, so I'm going to be brief. You can also find more details about their biographies on the center's website. David Greenlaw, next to me, is a managing director and chief U.S. fixed economist at Morgan Stanley. Prior to joining the firm in 1986, he served on the staff of the Federal Reserve Board in Washington, D.C. for 4 years. Jan Hatzius, next to David, is the chief economist of Goldman Sachs, where he co-heads both the Economics, Commodities, and Strategy Research Group in the Americas and Global Economics Research. Prior to joining Goldman in 1997, Jan was a research officer at the London School of Economics. Peter Hooper, on the far side, is managing director and chief economist of Deutsche Bank Securities in New York. Peter co-heads Deutsche Bank's global economics team. Prior to joining Deutsche Bank Securities in 1999, he was a senior officer at the Federal Reserve Board, where he enjoyed a distinguished 26-year career. During today's session, each panelist will make a presentation of up to 10 minutes regarding the economic and market outlook. I will then moderate a discussion for about 30 minutes, and finally we'll open up to questions from the audience. There are 2 mics, so we'll be asking you to go up to those mics to ask questions. We expect the full program to run about 90 minutes. So we'll proceed alphabetically with the presentation, and we'll begin with David.
Kim, thank you very much. This is a wonderful forum you've put together here. It's always a pleasure to see Jan and Peter as well. So there's obviously a lot to talk about. We don't have a whole lot of time for our prepared presentations. I've probably got 20 slides here. I'm going to focus in on 3 or 4 of them. And the ones that I chose to focus in on are the ones that probably are the most depressing part of the story. It's something I really wrestle with these days, doing presentations to clients. I was giving a talk in Chicago a few weeks ago, and I think it was a conference of high-yield investors. So the kind of thing, a couple hundred people, Morgan Stanley clients, bring in the Economist to give kind of a higher-level macro overview as the lunch speaker. And so I went on at about 1 o'clock, spoke for 45 minutes, did a little Q&A, and the head of the Chicago office gets up after me and he says, thanks very much, David. That was extremely depressing. In fact, the schedule for the rest of the afternoon is we have a short break now, and then we have some sessions, and then a cocktail hour tonight. We're going to change that to a cocktail hour starting right now at 1:45 in the afternoon. It's the earliest the bar had ever been opened at a Morgan Stanley event that I'd participated in. But as I was leaving, I don't have to stay for the rest of the thing, it's all these high-yield investors. As I was leaving, I noticed the line for the bar was all the way out the door. So the problem is it's not a very pretty picture at this point. I think Peter and Jan and I probably have a roughly similar view for growth in the U.S. over the course of the next couple of years. It's basically a sub 2% kind of growth trajectory for both this year and next year from our perspective. And one of the things that's driving that is the fiscal situation. So I thought I'd spend a few minutes talking about fiscal policy in the U.S., and in particular this fiscal cliff that I'm sure you've heard a lot about over the course of the last several months. So there are a number of items involved in the fiscal cliff. Some of them, not all of them, are listed here with rough estimates of the annualized impact of those policies. So we have the Bush-era tax cuts, we have the payroll tax cut that's been in place the last couple of years, some spending caps, et cetera, et cetera. So the bottom line is that these are very large programs that are all on autopilot. So in the case of the Bush-era tax cuts, they expire at the end of this year. In the case of the spending caps, they go into effect automatically at the end of this year if no action is taken. So how big is the fiscal cliff? chart on the left side of the page here is a little bit complicated, but let me see if I can walk you through it. So this is the change in the U.S. structural budget. It's a measure of the thrust of fiscal policy. So positive numbers are fiscal restraint, negative numbers are fiscal stimulus, and then there's one bar at the end there that represents 2013. And so the point of that one bar at the end is that if you assume current law, if you assume autopilot continues, so the Bush-era tax cuts expire, the automatic spending cuts go into effect, then we get something like 4% of GDP as the size of the fiscal cliff in 2013. That understates things a little bit because the historical data shown in this chart is fiscal year, not calendar year. And in this case, somewhat uniquely, all of these changes occur automatically on a calendar year basis. They're all January changes. So you really need to adjust from a fiscal year to a calendar year. You do that, you get up to 5 points of GDP. And you can see that historically, we've really never had anything like that over the course of the last 50 years or so. The one period that came closest was 1969 when President Johnson tried to pay for the Vietnam War by raising taxes. Just as an aside, the US economy was doing pretty well at the beginning of 1969. By the end of the year, we were in recession. It wasn't entirely because of the fiscal policy changes, but they certainly had an important impact. On the flip side, the most stimulus we've had in the post-war period was in 2009 when we had stimulus amounting to a little bit more than 4 points of GDP. But the important point here is that the size of the cliff is very large. So how do you extrapolate that cliff to a potential impact on the overall economy? The size of the cliff given as roughly 5 points of GDP. So the way you do that is with a multiplier, and there's a lot of debate and disagreement about the size of multipliers within the economics profession. The point of this table on the right side of the page here is to show that while there is a wide range of plausible multipliers associated with each of these components of the fiscal cliff, the size of the cliff is so big that even if you use the most conservative multipliers imaginable, you still have a very big hit to the economy. You've got an economy that's growing at maybe 2%, a little bit better perhaps on an underlying basis. If you take that 5 points of GDP as the size of the cliff and then attach any reasonable multiplier, you can see that the US will easily be back into recession next year if in fact we go over the cliff. So that's a depressing part of the story. While the cliff is large, almost everyone in Washington agrees at this point that we will avoid the full effects of the fiscal cliff. How will we do that? When will we do it? Very unclear. This chart here just shows some relevant dates over the course of the next few months. One of the most common questions we get these days from investors, particularly overseas investors, is can you tell me when the fiscal cliff vote will occur? Those are obviously folks who don't really understand how politics works in the US. There is no scheduled date for the fiscal cliff vote. And if we've learned anything over the course of the last few years, it's that that vote will probably come as late as possible in the game as is conceivable. So all you really have are some markers here that might be relevant in terms of the fiscal cliff situation over the course of the next few months. Widespread expectation that we'll have a lame duck session of Congress at some point after the election, and then perhaps down the road somewhere in mid-February, you'll have the requirement for a debt ceiling hike being the catalyst for some sort of a deal. Hopefully we'll get there before that point, but as we saw last summer, many times Congress doesn't act until they're forced to. The need for a debt ceiling hike once again could force them into action. That doesn't come till, in our estimate, mid-February. So you've got an environment that is fraught with uncertainty. While there is widespread agreement that the cliff will be addressed at some point, no one really knows how or when. Another issue that is often raised by investors, especially, again, overseas investors who might not be as close to the situation as some of us here at home, is, well, you're going to have an election in a couple of months. That will resolve all of this uncertainty. Once we know the outcome of the election, we'll know what's going to happen with fiscal policy. Well, that's not really the case in my view, and it's not the case for a couple of reasons. One, I show here on this slide the current prices and some history, the prices for these election contracts in the Iowa electronic market. Some of you may be familiar with the IO electronic market. There's also an in-trade market. There's some other markets out there in which you can buy contracts on the outcomes of certain events, in this case, political events, the US presidential election and the control of Congress. And the most highly priced contract at this point for the presidential election is President Obama being reelected. Some kind of funny price action over the course of the last week or so that may be related to the convention, although I'm not sure why. But the president, last I checked on Friday, was trading at around 65 cents on the dollar. Clearly, lots could still happen there, but the point is that the market implied outcome for the presidential race is that President Obama will be reelected at this point. And then for Congress, the contract that's trading at the highest price is Republican House, Republican Senate. So in some sense, that's an even more divided government than we have now. The president being reelected and Congress flipping entirely Republican. So I'm not sure from that standpoint the election is really going to solve anything. Moreover, this gridlock situation that we find ourselves in now in Washington is not necessarily a new development. There's a chart here on the right side of the page that shows some data produced by some political scientists at Princeton, and one of them may be at NYU. McCarty, Poole, and Rosenthal. Is one of them at NYU? These are political scientists, not economists, and they wouldn't be in the Stern School, but I think Rosenthal may be at NYU. In any case, they have done some work on political polarization, looking at every single roll call vote in Congress stretching back to the 1800s. And they come up with a statistical measure, the distance between the parties. And that is a measure of political polarization. And the thing that is striking, if you look at this chart, is that polarization has been rising not just over the course of the last few months, but for the last several decades. So we're going to have one election that suddenly turns the tide here and creates an environment of more partisanship and more ability to address some of these important policy issues. So that's kind of the point where the folks who hear the story want to shoot themselves in the head and rush for the bar, because it's not a very pretty picture. Let me just wind up here with the longer term story, which is possibly even more depressing. So we have this short-term fiscal cliff that poses a lot of risks for the US economy next year. What about the longer-term situation? This is a slide that kind of sums it up pretty well, I think. On the left-hand side of the page, federal government tax receipts as a percent of GDP. The blue data is the history, and we're now at a relatively low 15.5% or so of GDP for tax receipts. That's low for understandable reasons. We've just been through a very deep recession, and we've had some tax cuts over the course of the last decade or so. The green line and the red line are two possible alternatives, but keep in mind that both of them assume the economy fully recovers, so the unemployment rate gets all the way back down to 5.5%. You have the red line if you extend the Bush-era tax cuts, the green line if you allow those tax cuts to expire. Now, really, no politician that I know of is advocating the green line. The president wants to end the tax cuts for upper income individuals. That would put you a little bit above the red line. That's really more of a political issue than it is a budgetary issue. You'd be somewhere around 19.25% settling in there over the course of the next few years on the tax side if you allow tax cuts for upper income individuals to expire. But let's call it 19% as a best case scenario, assuming the economy fully recovers on the revenue side. Finally, let's look at the spending side. So I divide spending up into four categories: healthcare, Social Security, interest payments, and everything else. If you look at Social Security, that gets a lot of attention. It's about 5% of GDP in spending terms today, goes up to 6% by the middle of the century. The miscellaneous category, other non-interest outlays, today 12%, going down to 9%, in part because that includes defense, and in these sorts of longer-term simulations, we're assumed not to have any more wars. But look at the top line, Medicare and Medicaid, healthcare, 5.5% today, going up to 12.5% by the middle of the century. And so that gets you a big budget deficit continuing over the course of the next several decades, because you've got receipts at 19, you've got spending at 23 going up to 28, and then layer on the debt service costs. So debt service today, very low, 1.5% of GDP, because rates are so low. But just assume that rates normalize. Assume 3% short rates, 4.5% long rates, and you get interest on the debt skyrocketing to 16% of GDP by the middle of the century, absorbing almost all of your tax receipts. So the debt service is the thing that kind of puts you over the top, But healthcare, Medicare and Medicaid, is the real underlying driver of this problem. And what is the real challenge for politicians? It's that polling data show that something like 80% of Americans don't want any changes to Medicare. So this is a very important political challenge. Hopefully we'll be able to address this challenge post-election, regardless of who wins the election. But it is something that the markets are very, very focused on, and something that poses a lot of risk to the outlook for the US economy. That's it. With that, let me turn it over to Jan.
There we go. Very good. Thank you. And let me add my pleasure at being on this podium. Normally, David, Peter, and I don't actually spend a lot of time on podiums together. I often hear about the work that they've done from clients, so it's very nice to be here and get their thoughts on where the world's going sort of directly. What I want to do is, in the interest of being complementary as opposed to talking about the same issues again, focus on sort of slightly different issues. I'll leave aside the fiscal cliff. I basically agree with Dave's view that there is a large amount of risk, of course, over the next few months, and I think the numbers are pretty scary. But what I would like to do is focus a bit more on the sort of underlying adjustment process that we're seeing in the economy and what that means for policy. And what I'd like to do is just talk about what the cycle sort of looks like, what we've been through, and the adjustment process we're currently seeing, and how far we're along this adjustment process, and what that might tell us for where the cycle goes from here. So. Here's a very simple chart. Just looks at the two key sectors of the U.S. economy, namely the private sector, households and businesses, and the government sector. Simply the financial balance, basically the budget balance of each sector, and I think it illustrates pretty nicely the very unusual excesses that you saw in the run-up, basically in the decade to 2007. This is a chart that we've been looking at for well over a decade as sort of a clue for the imbalances that were building up. Private sector in the sort of 97 to 2007 period was running a huge financial deficit. Spending was far ahead of income, up to 6% of GDP. That was basically the real economic counterpart of the buildup of debt that occurred really throughout the private sector, both in the corporate sector, especially in the late 1990s, and then the household sector and the financial sector in the 2000s. Then, in 2007, 2008, of course, the music stopped, and you got the biggest retrenchment in the private sector in U.S. history, at least in post-war history. And since 2008, private sector has been running a huge amount, very, very large financial surpluses. Spending has been at very, very low levels relative to income over the past few years, and the corresponding sort of imbalance on the other side was a very large deficit in the government sector. Now, I do think that we are making some progress. So while my forecast for the economy is not really any brighter than Dave's as far as sort of cyclical growth goes, I think 2% this year, 2% next year seems about right. I do think that we're making some progress. The private sector has been running some very large surpluses that has resulted in reductions in leverage, reductions in the debt burden, reductions in debt service costs, and we have unwound a significant portion of the excesses. And as that process continues, as the private sector makes more progress, the surplus comes down, spending rises more quickly than income. That taken by itself is actually a boost to GDP growth. If spending grows more quickly than income, That is a positive cyclical impulse. If that was the only thing that was going on in the US economy, we'd probably have not a rip-roaring recovery, but a decent recovery with growth, perhaps somewhere in the 3% range or a little more than that. Of course, the flip side is that at the same time that the private sector is sort of gradually moving back to a more normal spending versus income position, the government sector is cutting back. That cutback so far has been mainly on the state and local side. So state and local governments have been raising taxes and cutting spending, whereas the federal government probably still has most of that adjustment still ahead of it, and the fiscal cliff, of course, is part of that. So my best guess is that if the full fiscal cliff doesn't hit, but we only get a maybe 1 or 1.5% of GDP drag from fiscal policy next year, that we're basically going to stay in the same kind of environment where private sector is a little more positive, and maybe the growth impulse from the private sector actually starts to pick up a bit, and the public sector essentially offsets that and keeps you in roughly a 2% type of growth environment. I think on the private sector side, the area that's clearly the most positive, and the area where we're probably going to get, at least proportionately to the size of the sector, the largest growth impulse is really housing. Housing is a sector that should see a very substantial amount of growth over the next few years. We're currently producing far less homes than the longer-term demographics would suggest. Of course, that's necessary because we've got to unwind the still sizable excess supply of houses, but we're probably only at about half the longer-term demographics for housing. Housing starts are in the 700,000 to 800,000 range, and over the longer term, we're probably going to have to get back to something like 1.5 million. So that should give you a decent boost to growth over the next couple of years, 3-4 years or so. Against that, fiscal policy, of course, continues to be a negative, even in a baseline scenario in which you do get an adjustment. You do get not the full fiscal cliff hitting, but a compromise after the election. The other factor, of course, is the European crisis. Now, the European crisis is sort of lurking in the background a bit at the moment. What we've seen out of Europe over the past few months has been somewhat positive. This chart here shows our financial conditions index, our measure of the overall impulse to GDP growth in the US from financial markets, from the bond markets, the equity markets, housing markets, and FX markets. A lower reading in the dark blue line is a better reading. So over the last couple of months, we have seen an improvement there. And that improvement has been to a large extent, we think, driven by relaxation on the part of the market about the European crisis, as the ECB has moved in the direction of unlimited bond purchases, at least at the shorter end of the yield curve. And we're hopeful that at least as far as the financial disruption is concerned, we will actually see forceful action from the ECB, and we will stay in a situation where the spikes in short-term yields in the European peripheral countries are not going to be repeated the way they were last summer and then again this past summer. Having said that, I said Europe lurks in the background. We still think that the economic adjustment process in Europe is still a very painful one. The jury's still out on whether we will actually see a successful economic adjustment process. Financial stability is one thing, real economic adjustment is another. As we look at the European periphery, we do worry that the same kind of adjustment process that you're seeing between the private sector balance and the public sector balance in the US is not really evident in the European periphery. In the European periphery, private sectors are running financial surpluses, unlike in the in the period prior to 2007, but those financial surpluses are not particularly large, unlike in the US. The success in paying down debt in places like Spain in the private sector is still very much being hampered essentially by the weakness of income and the weakness of the economy. And at the same time, the pressure on the public sector to pay down debt and to reduce, well, before you pay down debt, you have to reduce the deficits, but the pressure to reduce the deficits quickly is much greater than it is in the US. In the US, we're seeing maybe 1 to 1.5 percentage points of fiscal restraint. In a place like Spain, we're probably seeing something like 3 percentage points of fiscal restraint, and that is weighing on the real economy to a much greater degree. So we do worry that as far as the real economy is concerned, Europe's going to continue to be very weak, and ultimately you do need an economic recovery in order to underwrite the financial stabilization. In the remaining 2 minutes, I would like to just quickly talk about monetary policy in the US, as far as what we're likely to see this week. This is perhaps something that's going to come up later on. We do expect another move from the Fed in the direction of unconventional easing. We're basically looking for a belt and suspenders approach in which the Federal Reserve extends the forward guidance on the federal funds rate from probably no hikes until late 2014 to probably no hikes to at least mid-2015, perhaps longer, and also starts another asset purchase program and starts another basically campaign to bring down longer-term interest rates even further, both as far as treasuries are concerned and in particular as far as mortgage-backed securities are concerned. Do we think it's going to be successful? We do think it's going to have some effect, but it's not going to be anything like the sort of 1, 2, 3, 4, 5 percentage points that we talked about with respect to the potential impact of fiscal policy. We would expect something like a 1/4 point to a 1/2 point from another asset purchase program. That's roughly what we would estimate from the programs that we've already seen over the last couple of years, and we don't think it's going to be a major boost. At the same time, we think the cost of starting another program in an environment in which inflation is under control and in fact is more likely to be underneath the Fed's target rather than above the costs are very, very small. So from a cost-benefit perspective, even a small boost we think is helpful. Now, what could the Fed do if they wanted to have a more powerful effect? I'll just leave you with that thought, and that is we think that if the Fed tried to basically focus on bringing back nominal spending and made a clearer commitment to essentially bringing nominal GDP back to the at least towards the trend that we saw prior to the 2007-2008 downturn, and adopted programs of purchases of unconventional easing that are basically unlimited in size until you are back to a nominal GDP path closer to the pre-crisis trend. We think that could have a bigger effect. We think that that could alter private sector expectations. We think it could bring down real interest rates via a moderate increase in expected inflation for a limited period of time. So the potential payoff could be pretty sizable. Of course, there are also more significant risks associated with such a shift in the Fed's targeting framework. So we think they're really only inching in that direction. We certainly don't expect a major shift in that direction. There may be an evolution in that direction, but we do think that if you think about monetary policy potentially having a larger effect, that might be the way to go eventually. Thanks.
Thank you. While we make the change of slides, if those of you in the back want to come up front to take seats, we promise not to bite you up here. Plenty of seats up front.
Thanks, Kim. Thanks very much for organizing this, and I was always delighted to be on a panel with Dave and Jan. So I'm going to cover some of the same territory, maybe try to sound just a little bit more positive, difficult as that may be for a dismal scientist. Problems and promise. Problems certainly in the near term for the next year to 3, depending on which part of the world you're looking at. But promise, I think there are some lights at the end of these various tunnels. The key points I'd like to make, 4 in particular. First, I'll give you my near-term forecast. The Fed will ease again this week. More quantitative easing I think will exacerbate the exit challenges they face down the road, but certainly the economic prospects and the weakening of the labor market most recently warrant further action, and the Fed certainly has some potency with its QE. Next 2 points, the problems. Certainly, as Jan and Dave have mentioned, Euro risk is very much at the fore. Unfortunately, it's likely to be with us for a few more years. I'll talk about that a little bit. Fiscal uncertainties clearly loom large. Dave did a very nice job covering that one. And then finally, treading on some ground that Jan covered here a little bit, but the U.S. does have the potential, I think, to be an engine of global growth again as we look out beyond some of these uncertainties. Now, first, the Fed. BSP's balance sheet policies have pushed real interest rates down, helped push real interest rates down substantially. QE1, QE2, the maturity extension program, all contributing. We've done some modeling of the effects here. And we don't think that the Fed has lost much in the way of its ability to affect market rates. Certainly the amount of decline, this chart we're looking at, the red line here, the 10-year Treasury yield. The blue line is a very simple term structure model based on business cycle variables that doesn't capture this most recent 150 basis points drop in the 10-year yield over the last several years. Now, if you throw in the Fed's action and the Euro risk, you do some flight to safety, you can explain most of this drop. The Fed action was the dominant factor there. So the Fed does have room to do more. The more it does, the further it gets away from where we'll eventually be ending up. So we are talking about an exit challenge. Keep in mind that the 15-year average of the 10-year yield prior to this crisis, during a period when inflation was averaging 2%, about where the Fed would like to see it, was more than 5%. That's some 400 basis points, roughly above current levels. We get further out there. It's going to be a rough ride in the bond market, no question. This is uncharted territory for the Fed. They're confident they can do this, but there are some questions there. Despite this very low level of yields, broad financial conditions are not yet in a fully supportive mode. A financial conditions index that Jan, Kim, and I worked on a paper for the Monetary Policy Forum a few years back does show that things have improved over the past few years, but we're still not back in supportive territory, if you will. Flows, ABS issuance, still way below what they had been previously. Volatility, a depressing factor, and there's a lot of uncertainty out there. Now, the uncertainty driven, number one, I think, by what's been happening in Europe. Jan showed a slide focusing on the more recent period, showing uncertainty having dropped. I'm looking here at the Italian and Spanish 10-year government bond yields relative to Bunds, and it's as a measure of Euro risk, and that certainly has risen. It's come back a little bit most recently, but it's still quite elevated. I expect it to improve a bit, but not a major improvement for probably a few more years. So what's happening in Europe? Why are we a little depressed here for the near term? Well, the muddle through seems to work. It persists because there is a strong political attachment to the euro in both the core and the periphery countries, and because of the high cost of failure or exit. But there's impatience in the markets. People say, well, why don't you do like the US here? Well, we're not going to get a US solution in Europe. Fiscal union, full fiscal union, and euro bonds are not in the cards in the foreseeable future. The German public will not support it. I offer you that observation, informed by some of my colleagues in Frankfurt. The solution that Europe is likely to come up with will be one that will maximize membership, both keeping core in and periphery in, is so-called conditional assistance, with the Euro stability mechanism doling out assistance and the ECB providing lots of liquidity so long as members make needed progress in fiscal and structural reforms. The outright monetary transactions program announced by Draghi last week, a very good example. Now, these reforms, of course, are unpopular. Monitoring and enforcing them will be done periodically, and that's going to be a market event each time it happens. And it means continued market stress, but that stress is needed to bring the reforms about in the face of this unpopularity. Basically, the euro area, we feel, is 2 years into a 5-year adjustment program, so expect substantial fiscal drag over the next several years. We're in recession this year, we'll be at zero growth close to it next year, and modestly positive in the year after. These reforms have a long way to go, but the euro area also does not get much credit for the progress, amazing progress that's already made. I mean, looking at fiscal positions overall across the globe here, euro area in the middle, their government general government deficit 2011, the black bars, was about half the US as a share of GDP. And the progress we're expecting over the next 4 or 5 years, far greater than built into current expectations about the US. So let me turn to the US. Dave covered this nicely, I think, but I'll make just a couple points. That fiscal cliff, by the way, this forecast, this IMF forecast here, does assume that we don't go over the cliff. The cliff, of course, I'm plotting here the budget deficit. As Dave mentioned, it drops by 4% of GDP, and that's an understatement in terms of its drag on GDP over the next year. Everyone's assuming we're not going to get that. We're going to kick it down the road. We're going to end up something like what the CBO wrote down as an alternative scenario, a much more mild downturn, drag of something like 1.5% of GDP. But if we get that, as Dave mentioned, we are facing a mountain of debt off in the future. CBO's alternative does have debt going above 200% of GDP, getting up into Japanese levels as you get into 2030 and beyond. If we went over the fiscal cliff, it would be very painful, but it would certainly move us into a much more sustainable trajectory. And it's interesting that the President's Fiscal Commission, Simpson-Bowles, came up with a fairly similar trajectory. Hopefully, we'll get some agreement in that direction, but I share Dave's pessimism about the political will to do so, and I think it's going to take a fair amount of pressure from the markets. So let me try to end on a positive note here and go over some of the territory that Jan did. The U.S., I think, is poised to be an engine of global growth. There are two factors. I think Jan touched on some of this, but certainly private investment is at historic lows as a share of GDP. Normally about 25% of GDP is running 4 percentage points below where it needs to be to have stocks of homes, of business output capacity, of consumer durables growing in line with an normally expanding population. As a result of very slow growth in very low levels of investment, slow growth of capacity, we are seeing some dramatic shifts. Industrial capacity utilization has bounced back almost all the way from an extremely low level back to historic norms. Likewise, Jan mentioned that we have further to go on the overhang of vacant homes. I think our measure suggests that we're at least very close to being back to a historic trend on this one. Certainly the very low level of investment with household formations beginning to pick up, you are seeing some pretty good progress. So my time's up. I was going to talk a little bit about the household balance sheet. I'll just say there quickly that net worth in the average household's balance sheet as a result of deleveraging, as a result of some improvement in the stock market, you're getting back to a 20-year moving average. Deleveraging does not have to pick up from here. Savings rates don't have to rise. There may be room for them to begin to come down again. Consumer spending can begin to pick up. So back to those key points. The Fed, I think, will ease again this week. More QE will exacerbate the exit challenges, but economic prospects certainly weak enough to warrant that action. The euro risk is likely to be with us for several more years. U.S. fiscal challenges loom large. And the U.S. does have the potential to be an engine of global growth again as this capital stock utilization rises and balance sheet adjustments continue. Thanks.
Okay. Thank you all. Those were great presentations, and thank you for being as brief as you were. It's not easy to do. It's much harder to make a brief presentation than a long one, so we should thank them for doing that. We've talked, most of your conversation was about the United States, and I'm sure we're going to come back to it, but let's start outside the United States. Let's start with the euro area. And as Peter described it, the policymakers there are trying to thread a needle, trying to figure out how to keep the system together when it's in crisis. What is your expectation of how that's going to evolve? And let's start with Peter. Do you expect the monetary union to remain in its current form, 17 countries, in the medium term, say 5 years from now?
Well, I'm not going to go out on a limb and say that Greece is going to be in there forever. They do have a huge mountain to climb, a major challenge they're facing. But they're not going to be leaving this year, as some have predicted. Certainly, I don't think the euro area is ready for that shock. It would be a significant hit to the other periphery countries. And a way will be found to carry Greece along for a while. Elsewhere, I mean, so Portugal's next on the list. Portugal's making some impressive, the amount of adjustment, pain, and suffering they're going through, and the political will to do so. Portugal's not a Greece in this regard, so I tend to be more optimistic. I think that the 5-6 decades of history we have behind this has a lot of momentum. There is support for keeping this venture going. You already have the ESM pretty well locked in as long as the German Constitutional Court comes through, and we expect it to do so later this week. But as you say, or as I tried to emphasize, this is not going to be an easy process. As Jan mentioned, there's a lot of private sector deleveraging still to come along at a time when you have quite a bit of fiscal contraction. It's going to be a period of very slow growth. Europe went through a lot of pain in the 90s to get into this, and I have to say on the sidelines I was very surprised by the amount of suffering they were willing to undertake to do this. So they're not going to give it up easily, I don't think. I'm going to be optimistic.
Jan or David, do you want to jump in?
Yeah, I agree with Peter. I think the commitment is very strong. The one thing that has kind of impressed me for the last 2 or 3 years, right through the European debt crisis, is that among the European investors, European clients I meet with, there is much more conviction that the euro will hold together than there is, I would say, among US-based investors who consistently over the course of the last few years have said, run the numbers. Look, Greece cannot survive. This whole thing is going to fall apart at some point. I think there is a commitment on the part of the Europeans to try to hold the euro together, and the resource transfers are going to occur in an attempt to do that. How big a check is Germany willing to write is still a question, but there is a very strong commitment to try to maintain the euro, and the Europeans recognize that. I suspect that some US-based investors are a little bit more skeptical still.
Yeah, I think that's. I'm on board with that as well. I mean, I do think that the costs of breakup are enormous, and I think that's true for the countries leaving, and it's true for for the countries that would stay behind. So I think those costs are economic partly, and they're partly political, because you would give up on the European unification process. That sort of lies at the heart of the European post-war order, and so I think I think they will mostly stay together. I would be with Peter that wouldn't go out on a limb as far as Greece is concerned. I do think that the sort of construction challenges and construction errors in EMU, that they're probably going to be with us for a long time as well. So I do think the European periphery is going to be in extremely rough shape. I think the extent to which they're cutting back fiscal deficits in a sort of front-loaded manner, rather than spreading it over a longer period of time, at a time when the private sector is pulling back pretty hard, I think is very problematic. If it's our estimate is that Spain is cutting back by 2.5% to 3% of GDP. If you look at the measures that have been passed, we think that's beyond the speed limit of fiscal adjustment. So we think that's actually at a point where additional fiscal restraint may not even improve the budget balance, because it undercuts growth to a degree that ends up being counterproductive. So our recommendation would be to spread the fiscal adjustment over a longer period of time. Obviously fiscal adjustment is going to be needed in these places. Structural reform is certainly needed, and I think it makes more sense to front load structural reform and spread the fiscal adjustment. But yeah, I mean, ultimately I do think the costs of unwinding it are large enough to probably keep that from happening, at least as far as most of the members are concerned.
Then, leaving aside Greece, does that mean that the debt of peripheral countries in Europe is an attractive investment today?
I mean, from a tactical perspective, I think it's important to recognize that we've seen a fairly sizable rally over the past few months, basically since the so-called bumblebee speech by Mario Draghi. For those who don't know what I'm referring to, many of you probably do. Mario Draghi gave a speech in London. When was it? In I guess July, where he said that EMU was like the bumblebee. It shouldn't really be able to fly, but nevertheless it does. And that was viewed as because of some of the things that he said, essentially. That they would do whatever it takes to keep European monetary union together. That was really the start of that rally in the peripheral government bond markets. So there has been a fairly significant amount of relaxation there. So I think additional gains are probably going to be slimmer. But at the moment, for what it's worth, we still do think that there's probably some room for spreads to tighten.
I wouldn't limit it just to periphery government bonds. I would say that risk is overemphasized throughout the financial markets right now. And I would say U.S. equities is as much as, maybe not quite as much as Euro government bonds, but certainly there's potential there.
Bank equities too in Europe?
Bank equities in Europe may be a little further down the road.
Okay.
I'm not going to
actually,
comment on bank equities.
let's just broaden that question. Based on the presentations you've made and your individual thinking, where are the markets not priced well for the scenarios that you anticipate? Where do you think that there are opportunities for investors?
So, I mean, I think, I do think that if you take a longer-term perspective, I think global equities are pretty cheap, and I think that's true in the U.S. to a degree, but I think it's more true outside the U.S. I think it's, it is probably true in Europe. I think it's probably true in Asia. There are a lot of things on the calendar over the next few months as you get into the U.S. election and get sort of into year end that explains why risk premia are high. But if you take a longer term perspective, I do think this is a decent. Decent place to be. Risk, equity risk is certainly cheaper, than it's been on average over the last few decades, and I think the returns are potentially attractive on an outright basis and certainly relative to fixed income.
The ECB has taken some important steps to address tail risk in Europe, so the Bumblebee speech and then the actions at the meeting last week. And if you can address the tail risk emanating from Europe, then a low rate environment like the one we're in domestically and to some extent globally is very good for risk. I have this discussion quite often with our equity strategist who argues that statistically, low rates are not a positive environment for equities. But I think there's a cause and effect problem there. You usually only get to these low rates when the entire global economy is melting down. And that obviously is not a good situation for risk and for equities. But when you've addressed the tail risks and you're clearly going to stay in that low rate environment for quite some time, that can be a very bullish scenario for equities and risk
Don't tell me
assets.
your equity strategist is even more pessimistic than you are.
He is, yes.
I think you have to price in something close to a recession to justify PE ratios where they are right now. I mean, at 14.5 for the S&P 500, when normally at this stage in a cycle you're closer to 20, you're obviously pricing in some bad news. And I mean, we're not ruling out the possibility of a downturn from here, and certainly the recent indicators haven't been all that great. But if things don't turn out quite as badly as some may reasonably fear for the U.S. fiscal front, and this European situation continues to improve, we continue to remove the tail risks as we have, I think there's a lot of upside potential there.
Would any of you care to put out the odds on a U.S. recession over the next 12 months?
Well, the New York Fed asks us to do that before every FOMC meeting in a questionnaire that is now released to the public. They don't give you each individual response, but they give you the questions that they ask primary dealers, and we all represent primary dealer firms. And I think my last response to that question was something on the order of 25% or so.
Yeah, I mean, ours was 25, and I think I think it's very bimodal. I don't think that this is a particularly high. If it wasn't for the the potential tail events, U.S. fiscal policy and European crisis, then I would say that recession risk would be actually extremely low, because this is not a point in the cycle when you look at sort of private sector imbalances, inflation, anything like that, where you would be particularly worried about a recession. So I'd put it, somewhere in the low single digits probably. But there are the tail events, and that's why it's a bimodal outcome. And if you were to see, a renewed complete breakdown of willingness to work together after the election, with the stakes significantly higher than in the summer of 2011. Then of course we could get a recession out of that.
We run a recession probability model, probit model, off that U.S. MPF Financial Conditions Index, and it's been right in around 20% recently, which seems reasonable.
Okay, come back to the United States a bit. Should we be surprised at this stage, given the relative weakness of the recovery, that inflation isn't lower than it is today? And should we be surprised at all, and why do you think inflation is as close to the Fed's target as it is?
Well, no question that there's been some pretty significant structural shifts in Phillips curve models over the last several decades, a significant flattening. The link between output gaps or unemployment and slack in the economy and the inflation rate has weakened substantially. Longer term inflation expectations seem to dominate. And the Fed has been pretty effective at convincing people it's going to be holding the line at somewhere near 2%. When you fall much below the 2 to 2.5% range that many of these expectations measures lie in, you start to see some upward pull. So I think that's part of the story. And then you've had some commodity shocks that have certainly helped to.
The other thing I'd say, I mean, I agree that expectations, anchored inflation expectations are certainly an important part of it. I think the other thing is that as you get down to lower inflation rates, it becomes harder and harder and harder to push inflation down. Economists like to call that nominal rigidities. Those are very, very important. You can see that, I think, in the experience of the US over the last 5 years. I think you can also see it in kind of cross-country experience. You could certainly see it in the Japanese experience of the past 2 decades. More broadly, if you look at periods of very large output gaps across countries, and you look at the amount of disinflation that came out of those periods of very large output gaps, you got a lot of disinflation if the starting point for inflation was high, and you got very, very little disinflation when the starting point for inflation was low. So from that perspective, the US is actually not a particular outlier, although it has been surprising. I would have thought if you told me how weak the recovery would be, 3 years ago, I would have said inflation would be lower than it is. But yeah, I mean, I think as you look at this cross-country experience, perhaps it shouldn't be as much of a surprise.
So I agree, wages are sticky downward, productivity growth is slowing for cyclical reasons. The inflation story going forward from here for the foreseeable future, the next couple of years, I think largely a commodity story. So commodity prices are going to determine the inflation environment for the next few years.
All of you have linked part of that, maybe David the least, but all of you have linked part of the inflation story to expectations. Presumably that's showing the effectiveness of the Fed's communication strategy and its recent shift to being very explicit about having an inflation target. But Jan, in your presentation, you mentioned the notion of using nominal GDP as a guide for Fed policy. Is that consistent with an inflation targeting regime, or do you think that would raise issues about what they've done?
I mean, I think over the longer term it is, because I think if the Fed were to, were to move towards a framework like that, the longer term growth rate of nominal GDP that would be targeted should be based on an assessment of real potential growth plus the inflation target. So the natural number to use for the targeted growth rate of nominal GDP would be something like 4.5%, with a 2% inflation target and a 2.5% assumption for real growth. Now, you could argue maybe that's still a little too high, maybe real potential growth, certainly if you look out a little further, maybe a little below that because of demographic shifts. So perhaps 4% would be a more conservative number. But I do think it should be tied, as far as the growth rate of prices in that construct is concerned, to the Fed's inflation target. But nevertheless, that would leave room for short-term deviations. Of course, in the statement of strategy and goals that the FOMC published in January of this year, they do emphasize that the 2% inflation target is a longer run target as opposed to something that needs to be hit from period to period.
Anybody else want to jump in?
Go ahead, Peter.
I would think there'd be some room for some stress in such an arrangement, that having faced with a nominal GDP target with the gap as large as we have right now, you would potentially be raising inflation to levels that many members of the FOMC would not be comfortable with. I agree there's room for some flexibility, but we may be talking about...
Potentially, yeah. I mean, I think that is certainly a tail risk in shifting to a framework like that. Having said that, my expectation would be that most of the catch-up nominal growth would actually be catch-up real growth as well, with only a relatively modest increase in inflation. Because I do think that in an environment like this one, quantities are more flexible than prices, and I think that if you did manage to generate an increase in nominal spending and an increase in nominal output, that most of that in an environment in which underutilized resources are still very sizable, we can argue about exactly how sizable, but clearly quite sizable, that most of it would show up in stronger real growth. But having said that, clearly there are risks associated with it, and I do think that despite the fact that Mike Woodford, who is one of the most well-respected monetary theorists in the world, made the case for a nominal GDP target in his speech at Jackson Hole a couple of weeks ago, that the majority of the FOMC is not close to going there at this point.
I'm very open to the idea that you should link a policy instrument to an economic outcome, and I think doing so may give you more bang for the buck in terms of moving the policy instrument around. And I think that's one of the reasons you find it appealing, is that you can specify your objective and then move your instrument and you get more powerful response. I'm just not convinced of the effectiveness of the policy instruments that are under consideration now. And that's what really worries me about moving to a scenario where you link that policy instrument to some sort of economic outcome. And I'm concerned that the impact may be on the inflation side and not on real variables, because we have a very small sample size in terms of analyzing the effectiveness of these balance sheet measures, and I'm just not convinced that they are going to be, over the long haul, effective in moving real variables.
So would you worry, though, and I guess pose the question a different way, do you worry that changing what appears to be the target at a time like this might seem opportunistic and raise doubts about the credibility of the Fed when they've been successful at keeping inflation expectations anchored?
Well, I think you would reaffirm the long-term framework. You would also say that of course you're in a place that is highly, highly undesirable. They've said that a number of times. They're doing a lot of things that are sort of intimately related to the fact that they're in a place they don't want to be in. They're using policy instruments that they would never think of using. So if you had a sort of temporary stronger statement that you want to go through a period of nominal catch-up until you're back to the pre-crisis trend, however defined, I think that wouldn't necessarily be such a so far out of line with some of the other very, very unusual things that they've been doing. I think it is a sort of framework that is getting clearly is getting more attention. There are a number of academic economists that have come out in favor of it. I do think that the Fed is moving more in that direction. I would expect, for example, the next round of quantitative easing, probably this Thursday, to be specified in a more open-ended fashion, which you could already interpret as a move in that direction. But it's a slow process. An alternative to a nominal GDP target, something that is perhaps a little closer to the current framework, but might nevertheless be quite helpful, is the so-called the Evans proposal by Chicago Fed President Charlie Evans to essentially commit not to raise the funds rate until the unemployment rate has fallen below 7%, subject to the condition that some measure of inflation, it's not entirely clear what measure, but I think some kind of core inflation, underlying inflation measure is not above 3%. That is also definitely a significant step in a more aggressive direction from the perspective of the Federal Reserve, but it might be a little more palatable at the moment. Again, It's not something I would expect this Thursday, but I think we might be a little closer to that than to a full-blown nominal GDP target.
And that's a change in communication strategy that makes a lot more sense to me. I think the problem is that when you're faced with an FOMC that is already a somewhat divided committee, it's very difficult to reach agreement on those specific thresholds. So Evans wants unemployment rate below 6%. Koch Lakota says we can't get below 7%, so you've got a big divide within the committee on what those specific thresholds might be, which limits their ability to come to an agreement.
Yeah, I mean, evidence is saying 7, and it seems like the committee is not expecting any, it's not forecasting any hikes until you get into that neighborhood. So yeah, if all 19 had to sign up to the same number, I think that would be extremely difficult to generate a majority for. I think if you need a sizable majority of the voting members with the chairman, essentially, leading the way and of course pushing waivers in the direction of voting for it, then it might be a little easier to generate. But yeah, the 19 are never going to agree on on any of those numbers.
But that's a problem because we're talking about very long distance sort of commitments or conditional commitments, and the committee is going to change over time. Fed Chairman Bernanke's term expires at the beginning of 2014. I think there is very limited likelihood he'll be around after that point. So how do you set up some sort of link between communications and policy that the market believes is going to be sustained through different policy regimes?
I think Chairman Bernanke got that question at one of the press conferences. I think it was in April, and I think his answer was that while the identity of the chairman will shift, there's a lot more stability in the committee as a whole. But I would agree that of course if you had a shift in leadership, depending on who it is, that could of course lead to a more sizable shift in the framework as well.
I wouldn't be surprised if Michael Woodford hasn't had some effect here. I mean, I agree with you, Jan, that I think an open-ended arrangement, maybe taking a page out of the ECB's playbook with their OMT thing here, but some form of policy action now I think is important to bolster their verbal message. That was a key element in Michael's message. I don't think it has to be, I think there is discomfort with going too far down the road of constraining yourself, committing yourself to something you might be uncomfortable with down the road. But some action now I think is certainly called for.
I'm going to ask the folks who would like to ask questions to go up to the microphones now, and we'll start taking questions. But while you're doing that, I'm going to ask one last one based on this latest set of discussion. And that is, it sounds like each of you, if you had your druthers, would welcome a bolder, more aggressive accommodation from the Federal Reserve in some form, whether it's a change in communication or a change in the scale of action. Am I correct in hearing that?
I think that's a fair.
Certainly true as far as I'm concerned.
Yeah, sorry?
Yes.
Peter?
Yes, I think we've called for some action this week.
David?
Yes, I'm not crazy about the two specific options that appear to be on the table for this week, but I think it's very easy to make the case for additional accommodation of some sort at this point. There are other measures that I would be more supportive of than the ones under consideration, but it's, again, clear that more accommodation is justifiable.
Great. First of all, let's start by asking you to identify yourself as a student, MBA, undergraduate. Why don't we start on this side?
Hi, I'm an MBA student here at Stern, and to each of you, if you were given unlimited control over U.S. fiscal policy, what would be the one or two top changes you would make to our fiscal policy?
Who wants to be the first czar?
Well, so the ideal, I think, at this point that folks are striving for is we've got these two problems, right? We've got the short-term fiscal cliff, which poses significant downside risk, and then we've got an unsustainable trajectory of fiscal policy looking out over the longer-term horizon. Ideally, you'd want to fix both of those together. That's the ideal that Chairman Bernanke has tried to lay out for members of Congress whenever he testifies. We've come close to doing that. We came close last summer during the debt ceiling negotiations by many accounts, came very, very close. So that would be the ideal, I think, is to resolve the fiscal cliff that poses these risks in the near term, while at the same time taking action that puts us on a sustainable course longer run. I think almost anyone individually could look at the budget and do that in a way that is economically viable. The problem is the underlying politics. Very, very difficult to get together on a solution when two different parties with very different views are involved. But there is room in the middle, I think, for a compromise agreement.
Simpson-Bowles laid it all out. I agree. You need to delay the near-term fiscal drag from the cliff, but you need to adopt something akin to Simpson-Bowles, and that basically says equate the revenue share of GDP and the expenditure share at roughly 21% each down the road. That's going to take quite a bit of work on entitlement reform. It's going to take tax reform. That's where I'd go.
Yeah, I mean, I'm on the same page. I mean, you know, whether the specifics of sort of Simpson-Bowles and the specifics of the, you know, tax and expenditure share of GDP, you know, whether those are the right numbers, that's ultimately a political decision. I mean, I do think that over the longer term, you probably will need to see increases in tax revenues. I think an obvious place in the U.S. Is indirect taxation. That is relatively low by international standards. I suspect that we're going to see more of that, and probably also at the federal level. You know, energy taxation is another area where, you know, obviously the U.S. is very, very low by international standards. So I think we'll probably see something in that sort of direction. But I do think it's extremely important to you know, commit to long-term fiscal sustainability and to, you know, make a sort of down payment in that direction. But I would say a gradual one. Anything more than you know, a drag of, you know, 1% of GDP in the sort of environment that we're in at the moment, I think would be you know, would be potentially counterproductive.
Indirect taxation, a very politically correct term. Would you care to value-added tax?
Sales taxes, value-added taxes. You know, they're generally sales taxes currently at the, you know, state and local level, of course, but internationally, you know, it'd be a value-added tax. There are different ways in which you can raise it, of course, but I think we'll probably see more of that. Yes.
Hello, John Sarushian. I'm a MBA 1. Being in an election cycle, I was very curious about your thoughts on the different election outcomes and the effects they'll have on resolving the fiscal cliff as well as fiscal policy in general. So I'm thinking of if Obama gets reelected with a unified government, divided government, or a similar scenario with the president or potential President Romney.
I mean, I think I suspect that you know, status quo or status quo modified, meaning that the Republicans take the Senate, but otherwise you stay you know, with Obama in the White House and Republicans in control of the House of Representatives, probably poses the biggest risks for having a bad outcome because that's probably the environment in which neither side is really fully able to impose its will, and you know, game of brinksmanship, I think, is most likely in that environment. You know, between the two more sort of extreme outcomes, with one side taking control, I think it's a little harder to say. You know, which one would be you know, would be more likely to sort of cause a big problem in, you know, during the lame duck session in early 2013. But you know, I think in either case it'd probably be a little easier.
I agree. I think it's difficult, though, to draw simple and straightforward conclusions. One of the things that I encounter a lot from investors is the notion that, well, if the president's reelected, we know that income tax rates are going up on upper income individuals. I don't think that's the case at all, because if the president is reelected, the Republicans are never going to give him legislation that allows him just to raise taxes on upper income individuals. It will be an all or nothing proposition. And if the president is reelected, he probably owns the economy to an even greater degree, and it's going to be very difficult for him to accept higher tax rates on everyone. But those are the choices that the Republicans are going to give them. So it gets very complicated and very difficult, I think, to draw any clear conclusions from the outcome of the election. And that's why the market is so concerned with this policy uncertainty.
Yeah, neither party is going to get complete control of Congress. You're not going to have 60 votes in the Senate, which you would need to get done what you really wanted to do if you wanted to do some real serious reform one way or another. If, contrary to your chart, David, the Republicans were to sweep and get 60%, you would probably get a Republican solution that would most likely result in a shift in power 4 years hence, and then you get a shift to a Democratic solution.
That could undo all of it, yes.
You really need a compromise solution.
If you did get a Republican clean sweep, there are a lot of things they could do through the budget reconciliation process that the president used to enact health care reform, and which would mean that they don't need the 60-vote supermajority in the Senate. But it gets very difficult when you get down to specifics on tax policy and even some of the spending programs to keep all the Republicans in line. And so you still may have to do negotiations with the other side to reach a final agreement on a lot of this stuff.
Thank you. Great.
Good afternoon, gentlemen. Matt Mitchell here, MBA candidate. Assuming it continues to climb, specifically, how much higher can the debt to GDP ratio here climb before the U.S. is incapable of servicing its debt and in effect defaults? Thank you.
So at these levels of interest rates, it can go a heck of a lot higher. But the risk is at some point interest rates normalize, right? So that table that I showed today, even though we've grown the debt quite a bit over the course of the last 5 years, interest expense is still only 1.5% of GDP. That's because a quarter of our debt's financed in the bill sector, and bill rates are essentially zero. Anything else that's been issued in the last 5 years has a rate that's pretty close to zero. So financing costs are quite low. Can this continue for a long period of time? It probably could. But at some point, you probably face some normalization of rates, which makes it much more problematic.
U.S. debt levels approaching 100% of GDP, general debt. Japan's are already in excess of 200% of GDP. And Japan, the yen is still a safe haven. Of course, they owe most of the debt to themselves, whereas we owe half of ours to the rest of the world. Right now, there's no real alternative to the U.S. Treasury market. If the euro were to become phenomenally successful here, maybe we could grow an alternative and the U.S. would have to worry a bit sooner. So a lot depends on what's happening around the world to pin down your number.
Yeah, I'd say the risk goes up. The higher, partly because of these financing issues, the higher the debt to GDP ratio is. If you look at it on sort of a cross-country basis, though, incidence of a financial crisis versus the level of the debt to GDP ratio, you do get a relationship. So the likelihood that you'll end up with a crisis is higher, but it's far from it's far from a tight relationship. You look at Japan as an obvious example. I think the UK, a couple times in its history had debt to GDP ratios of more than 200%. And ended up servicing the debt. Didn't experience a financial crisis. Now, obviously, in very, very different environments, but you find plenty of cases in which countries have seen a financial or even a fiscal crisis with very low debt to GDP ratios and the converse. But the risk does go up.
But last time Bernanke testified before the House Budget Committee, Paul Ryan beat him up a little bit, saying, look, we need to feel some pain. You guys are masking the pain that we should be seeing from all these debts. Take your foot off the gas, let rates go up a lot, and then we'll solve the deficit problem. Bernanke's saying, well, is it really necessary to go back into another recession, to feel all this pain, to solve the problem? Why don't you guys just get together and do it before we feel the pain? So it was a very interesting kind of exchange between Bernanke and Paul Ryan at his last appearance. And there's something to be said for the fact that policymakers are not going to get serious about addressing these problems until the public and the economy feels some pain.
So we're going to have, if we have gridlock next year and substantial downgrade.
We're going to feel pain?
what's going to happen in the bond market, David?
We might feel some pain.
Hello, Michael Christofi, undergrad. So it seems a lot of what you guys touched on were the two main issues revolve around the fiscal cliff and around Europe. So I have two questions. The first is that given the fiscal cliff, why would more quantitative easing from the Fed impact markets significantly? And my second is that Jan did a good job of connecting the coupling between the European and US economies, specifically with his chart that showed the FCI and Euro risk. So I'm wondering whether it's an option for the Federal Reserve to purchase Spanish or Italian debt, if it's even an option.
Legally, yes. Practically, no. But
If you think Paul Ryan beat him up on that last appearance, wait until he goes before.
yeah, I mean, and I think, I think the first question, is a good one if I can sort of broaden it a bit. And this is a question, probably all of us get very frequently. Namely, whether monetary policy, is the problem, and whether what the point is of loosening monetary policy if monetary policy isn't the problem. I think we can probably all agree that excessively high interest rates are not the problem that the U.S. economy is facing, and the problems are elsewhere, and they're fiscal, and they're to do with global spillovers. But the truth is that the policymakers that are most concerned about the overall macroeconomy, namely the Federal Reserve, only control monetary policy, and you don't have to reinflate a flat tire through the puncture. There are other things you can do to basically offset the negative impacts from things like fiscal policy, and those under the control of the Federal Reserve, of course, are conventional and unconventional monetary policy. And so in that sense, I think monetary policy is not a perfect offset. It's not the most important driver of kind of the uncertainty and the ups and downs in US GDP growth. I think the uncertainty around fiscal policy is several percentage points of impact on GDP growth. The uncertainty around monetary policy is quarter point, maybe a half point, maybe a little more if you want to get a little fancier and more aggressive, but it is unfortunately the only thing that's under the control of the Fed.
I would observe that the Fed and the ECB have two very different objectives right now. The ECB is in a fight to build a structure that will ensure its survival. The Fed is merely trying to meet its mandate of achieving maximum sustainable employment, and it has some scope to do so.
We've got about 5 minutes left, and I see 4 people with questions. So I'm going to ask you to all ask your questions one at a time, but we'll hold the answers until we get them all. This will be the last round, and we'll try to answer them all fast.
Mine was quite big. I wanted to know your views on China, how obviously the slowdown is going to affect the US and Europe, and just talk a bit about that.
Assuming another round of quantitative easing is announced, are you expecting this market rally to continue, or are you looking at the possibility for a correction?
Draghi has recently spoken about sterlized bond purchases. What sort of an impact could it have? How can that be implemented? If you could throw some light on that.
Sorry, the purchases in Europe.
Yeah,
how would they be implemented?
Sterlized bond purchases.
I was wondering if you could talk more about exit strategies and what happens when the Fed stops paying interest on the excess reserves.
That should take a half an hour or so.
Exactly. We're going to do 1 minute each for those 4 questions. So, Peter, you mentioned exit strategy at the beginning as a worry, so why don't we start with that one first?
When the Fed stops, well, the Fed will continue to pay interest on reserves as a key way of enabling itself to begin to raise rates with a hugely expanded balance sheet. That is it's not going to change that. Its exit strategy will be first sign will be when they decide to stabilize, allow the balance sheet to run down by not repurchasing maturing assets. Next, they'll begin to raise rates. Then they'll begin to maybe sell some assets and drive up longer-term rates a bit. But raising rates will be done via interest on reserves. That's how that'll be their chief monetary control mechanism.
China?
I take China.
Please.
I mean, I think China has been very disappointing this year, and I think it's disappointed a lot of people. It certainly disappointed us. Our expectation coming into this year, last year we expected a slowdown in China, basically because the economy was overheating early in the year. Policymakers were tightening macroeconomic policies in order to cool things down and bring down inflation. This year, it's taken quite a bit longer for the policy stimulus to be applied and the economy to stabilize, and it probably still hasn't quite happened than we would have thought. Despite the fact that inflation has come down a lot. I think the issues are still somewhat unclear. Part of it is certainly the leadership transition, which is making it harder for the leadership to really be focused on sort of short-term macroeconomic stabilization. The concerns among the Chinese policymakers around longer-term imbalances, especially in the housing market, are also substantial. So they're worried about applying large stimulus in an environment in which house prices and housing imbalances still haven't really corrected. And it may also be that it's just harder to promote a reacceleration of growth with the policy instruments once they are applied, basically because the sectors that are easiest to stimulate are already have already been stimulated substantially. So, our guess would be that things do get a little better in 2013. Growth does pick up a little bit after the leadership transition. You do get somewhat more supportive macroeconomic policies, but we don't expect a return to the sort of 9 or 10% growth rates that we've seen at times in China anytime soon.
There was a question on. Let's see, on Draghi, I think he said that the ECB will be purchasing government bonds in the secondary market as conditions necessitate or warrant, but only if the countries whose bonds are being purchased have agreed to an assistance program, and they're in that program, they're undergoing reforms that are being reviewed. So that's that conditional assistance, if you will, which is, I think, is at the core of how Europe is going to be operating things going forward. And my sense is if we get QE, there'll be some, it's not fully priced in the market, so you'll get some lift.
I guess that would be, I think we were all personally kind of mildly bullish on equities. I guess one near-term potential risk would be that if we do get QE and the market doesn't respond favorably, that could be important. Most of the research suggests that whatever positive effect you have on equities and financial conditions from QE comes on an announcement effect. We're, I think, probably going to be seeing very little new from the Fed in terms of the portfolio balance channel. So if they announce QE, they're likely to shut down twist, and the magnitude of the duration removal in the marketplace probably not going to be all that different. So I'm a little bit skeptical about the direct impacts of QE on the equity market, but I think that the market would expect some sort of favorable response if the Fed does make the QE announcement on Thursday. A concern would be if that favorable response in the market is not evident.
You might not get a drop in nominal yield, treasury yields, but you could get a drop in real with an increase in inflation expectations, I guess, right?
Mm-hmm. There was one last question. I'm not sure we picked up on it.
I think we covered them.
I think we covered them all.
We got them?
Yeah.
Okay, well, let me thank, first of all, let me thank the panel. I hope you'll join me in showing your appreciation. Thank you. And in coming days, we expect to post a video of this session, and I hope you'll let your colleagues know. Quite a few of them were turned away. We didn't have enough space in the room, so we hope that you'll let them know that they can get access. And we hope you'll also join us again at the beginning of the next semester when we're likely to do another forum. Thank you very much.